Hello, my name is Lachlan St Clair. I'm the principal here at CSP, and welcome to the December edition of Smart Money. I want to take this opportunity to talk a little bit more about investment markets. When we did our newsletter in early November, the view was that, in particular for the equity markets, that the pullback was really just a late cycle shakeout. However, it's fair to say it's probably gone on a little bit deeper and been a little bit more prolonged than people were expecting when we first started to discuss this. We've actually included a market update from DNR, so you can see Jamie Nichols' views on the current market. However, I must say, when we're doing our 10-year forecasts at the moment, with the equity market, the domestic equity market I'm talking about here, sitting at around the 5,700, high 5,600s, the valuations are starting to look really compelling. We're starting to see forward 10-year forecast returns well up into the 9.5% marks. And indeed, for the world, excluding the United States, the returns are up at over 10.5%. That being said, the United States market, even with the current pull-off on the S&P 500, we're still looking at returns well below 4%. So the US does still look very expensive to us, and we'll probably continue with our strategy of de-risking or deleveraging towards the United States. However, for the money that we pulled out of the markets in July and August of this year, particularly for our pension clients, if the market continues to trade around about where it is when we get back on deck after Christmas, we may well look at starting to at least drip a little bit of that money back in again and take advantage of what is fundamentally some pretty good buying opportunities. So the domestic equity market and the global equity markets have continued to soften. We really think it's due to a slightly softening economy, but there are also a lot of geopolitical risks floating around at the moment. I think it's just given the market the willies, so to speak. You've got Brexit. Is that going to be a hard landing or a soft landing? So a number of these things together, I think, is really just softening, losing a bit of confidence, and certainly leading to a bit of softness in the economy and leading to a little bit of softness in the investment markets. But again, it's where you buy at these levels, and once this confidence, or lack of confidence, I should say, dissipates out of the market, markets recover, that's how you make money. So our leaning at the moment, or our tilt, is certainly towards potentially starting to dribble some money back in as the market's pulled off. From a US bond perspective, the US Federal Reserve is expected to increase rates by 25 basis points this current month. The US Fed is saying they're going to increase 4 more times next year. However, if you have a look at the bond market, the market is not pricing in any more rate rises after December. So the December minutes are actually going to be quite interesting for the US Fed. We do expect that if that rate rise starts to come out, or that prospect of the rate rise comes out, there may reduce some pressure on US bonds, and I think that will be a good thing for the market as well. Just to comment as well on property, particularly Australian property. Clearly, the property market is off sort of 5 to 10%. But I think it's important to put a few things in context, because if you just read the front page of the paper, some of the hysteria that they can bang on with is really unhelpful and quite extraordinary. The current pullback of sort of between 5 and 10%, which is really what it is at a broad level, is something that was manufactured and is by design by the government. The Reserve Bank and the government wanted to bring property prices back 5 to 10%. And that's what has happened. So this is by design. This is what the government has wanted to do. Now, the key reason, or how that has occurred, the key determinant one of the key determinants in the price of property is availability of credit. How much the bank will lend you very much determines how much you're able to pay for a property. And so what has essentially happened is that the government, through regulation and a couple other mechanisms, has tightened up the credit available to the banks, and that's reduced the credit available to purchasers, and that's what's brought the property market off. So there's really 3 components to what's drive that credit up, and this is important because you need to understand what they are to understand if they can turn around or not. The first is the Royal Commission. That has clearly led to an increase in risk aversion by the banks, and so when they're making their decisions, they're coming down on the more conservative side of the decision as opposed to the aggressive side of the decision. That's a cyclical factor that we will work our way through. The second factor is to do with regulations. So APRA has told the banks that they are to limit the availability of credit, and therefore investment loans such as interest-only loans for investment properties are now very hard to get. And that has led to a reduction in the credit available. The third component is a bigger global issue, and it's, without going into too much detail now, because the US Federal Reserve is trying to roll off all the bonds that it bought from the US government 10 years ago when they started the QE process. The US government needs to reissue those bonds to the rest of the global market. And it's $50 billion a month is the roll-off rate. And so that is simply sucking credit out of global credit markets, and that is making it more difficult for our banks to access credit globally. what's important to understand is that if the property market falls too far, then the government can put credit or allow credit to be put back into the property market. They can make interest-only loans available again, as an example. They can also reduce interest rates. There's a number of mechanisms the government can use to make sure the property market is stable. And I think it's important to understand the government goal is stability. There is not a government in Australia, not a politician in Australia who wants to oversee a 20 to 30% fall in property prices, not least of which is because they've all got their own investment properties anyway. So I think what we're seeing at the moment is something that the government has done by design and what they want. If the property prices start to come off too far, there are some steps they can take to stabilise the market. So I suppose what we're saying is try not to get too concerned about the front page of the newspapers. Their job is to sell articles at the end of the day, or sell stories. The property market is behaving as the government, the regulators wanted it to behave, and as long as it continues to do that, which has basically come down a bit and stay stable for a while, I think that's what will happen. And if it doesn't happen, then there are steps that they can take in order to stabilise things. Just a couple of other comments before we go. Firstly, congratulations to Magellan, the Magellan Infrastructure guys. They won the Infrastructure Fund of the Year Awards at the Zenith Fund Awards in the last couple of weeks, which is a fantastic result for them. It's not something we're very good at promoting when the funds in our portfolios win awards, but they do win a lot of awards. So from now on, during these Smart Moneys, we will acknowledge those because I think it's important to do so. Just a final one as well on Christmas. Obviously, Christmas is just around the corner. The office is closed from Friday, the 21st of December, and will reopen on Wednesday, the 2nd of January. We'll be on a sort of fairly limited staff during that time, with sort of people still taking a bit of holidays. Personally, myself, I won't be back on deck until after the Australia Day long weekend. So for all of our clients, we wish you all a fantastic Christmas and a safe and prosperous 2019. We trust everybody gets some time away with their families, and we look forward to catching up with everybody in the new year. Thank you very much.